So today we are starting with dollar roll transactions. Okay. So what is this dollar roll transaction? Dollar roll transaction is a form of repurchase agreement. See what is repurchase? First you'll sell and again purchase it. In which an investor sells a mortgage backed security during one period. So you are selling mortgage backed security during one period called the front month. Okay. That is you are selling today, for example, and later you are buying back. Okay, later you are buying back. So why are you doing all this? Why are you selling right now and buying back? There should be some kind of benefit in this, some profit in this. Okay, let's see what is that. So if you go through this theory better than this, if I go through the practical question, you will understand in a more better way, Chandra. Okay, shall we do the practical question?
Yes,
Yeah,
sir.
yeah, 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 yeah. So what is happening here in doing this particular, he is selling in the front month and buying back in the later month. The investor relinquishes their access to the principal and interest on the loan that is sold. So the investor receives cash from sale, which could be reinvested and used to purchase the security later. So all these things you'll understand properly if you see this question. Let us see this. So TBA is nothing but to be announced. Prices of Ginnie Mae. You know this Ginnie Mae and this Freddie Mac something is there. Now these guys purchase the mortgages, okay, from the secondary market and then they sell by converting them into securities. So Ginnie Mae, for January 12 and February 12 settlements are. So here you can see to be announced prices of Ginnie Mae 3% for January 12 and February 12 settlements are this. These are the prices. So in January 12, if it is settled this, February 12, it is settled this. The accrued interest, outstanding interest to be added to each of these prices is this. So this you have to add. The expected total principal pay down. Scheduled principal plus prepayments is 2% of the outstanding balance. So 2% is like principal and prepayment, and prevailing short term rate is 1%. Also assume that the actual 360-day convention is applied. So this is a very easy question. So he just wants to know an investor wishes to roll a balance of 10 million. So dollar rollover transaction, we will see what is the benefit to the investor by this dollar roll transaction. So let's see proceeds from selling the January 12 to be announced are 10 million into what is this? 102.30, that is January 12 settlement, and settlement amount and the interest you have to add. So this is coming to this 10 lakhs. So by 100 it is coming to this. Okay. Now like investing these proceeds to, now he has sold this, Chandra. He has sold this. Okay. He has sold this and got the money. Then again he will repurchase afterwards. So he sold it and got this money, and this he is investing. Okay. To February 12 at 1% interest. Okay. On that. Okay. So now you know from Jan to Feb, it is like Jan 12 to Feb 12, it is 31 days. Okay. 31 days. So he is investing and he is getting 1% interest. So this particular amount which he got after selling, that he is investing to till February 12, he is earning 1% interest. For 31 days, it is 8,820. Next. Now he purchased the to be announced in February, which has experienced a 2% pay down. Okay, that means it has declined 2% pay down, and he is purchasing at less. Okay, so that is 10 million into 1 minus 2% into the 102.10 February's rate plus the interest. It is coming to this. Now net proceeds from roll therefore are, that means you have sold it at this, you have got the interest, and now you are purchasing at this. Okay, so you are getting, this is the net amount. So these two added together is like this one, the sale amount, the amount at which you sold, and this is the interest you got which you after selling you invested and this is at which you purchased. So this is the difference coming out. Now if the interest if the investor does not roll. So if you would have not done this dollar rollover transaction, Chandra, if you would have not done this dollar rollover transaction, the net proceeds are the coupon plus interest paid on. That is, you will be getting the coupon, the interest. Okay. Let us see. %3. It is like 3% and 2% of the outstanding balance. So 3 by 12 plus 2%. This is what you would have got. So now value of the roll is you got after the dollar rollover you got this much. Now if you would have not rolled, you would have got this much. So you are having a benefit now with this roll of $8,270. It's a good deal for you. So people do that if they have good benefits. That means they sell it and repurchase when the prices are down. With that, they have made a benefit for themselves. Now, there are some other agency products. Chandra, have you got it? Shall I move forward?
Yes, sir.
Yeah. Okay. Okay. Just a second. Who's this? Okay. So other agency products, collateralized mortgage obligation. It involves creating tranches, classes of security that bear different amounts of prepayment risk. Assume that there are two tranches A and B. So you have a very good idea about what are tranches. Tranche A investors finance 60% of principal while tranche B investors finance 40% of principal. In this example, tranche B bears most of the prepayment risk. Why? Because it's a B tranche. Not only B tranche, but it is the data they have given that they bear most of the prepayment risk. Each tranche will get interest on its outstanding principal. Okay, that means the good securities come under tranche A, bad securities come under tranche B, and tranche A, like, good prepayment is expected. Why? Because those are good, those are the customers with good profile. Tranche B, you cannot expect good prepayments. Okay, because those are not with good profile, the customers, and each tranche will get interest on its outstanding principal. Okay, and principal payments will only be paid to tranche B after paying tranche A investors. That means whatever they have borrowed, the bank or company has borrowed, they need to repay. So interest only securities, interest payments from mortgage securities will be directed to the interest only securities. Principal only securities, principal payments from mortgage securities will be directed to principal only. These are the categories. So interest only in sense, interest only, interest payments from mortgage securities, the ones which are mortgage, will be directed to interest only securities on which interest only is given, and principal payments from mortgage will be directed to principal only securities. Now, non-agency mortgage backed securities. What is this? So non-agency mortgage-backed securities are issued by private corporations like big companies, financial institutions, and are not guaranteed by government-sponsored institutions. Because people believe that these big finance institutions or big private corporations are good profitable companies. Okay. So like banks sell a mortgage portfolio to a SPV. The SPV then creates, okay, we know that how it happens. So banks, what they do, they, whatever the mortgages they have, they transfer it to SPV. SPV converts that into or creates into securities, and they will be like selling it to people, and that will be going through pass through, as we have yesterday seen the pass through, how the pass through model follows. But here default risk, if there is a default, the the investors are not protected. Okay, investors in non-agency mortgage backed security are not protected against default risk. Why? Because these are private companies, and if the value or if they default, then and at the time when the value of the securities is lost, since they are not government regulated organizations, they are private ones, you need to be cautious before investing into them, and there's no guarantee. So hence now it is upon you and your risk, but you can get good interest. Why? Because risky ones, risky na, so they will pay you more interest. So if you are risk taker, you can approach that one. Now, modeling prepayment behavior. So banks, they don't like prepayments. Why? Because if you make prepayments to banks, they will lose interest. They may like it also. At times they may not like. Why? Because they lose their business. Because interest is the income for the bank. Okay. So prepayment risk is the risk involved with premature return of principal on mortgage. So prepayment effectively renders the borrower free of mortgage obligations. A mortgage prepayment option works much like a call option for the borrower. Okay. So why call option? As the time passes, your liability, whatever you have, you want to pay off. Am I right? So a mortgage prepayment option works much like a call option. So what is a call option? You are holding for a certain period of time, and when the time comes, you will sell it. Suppose you have a stock and you have a bullish sentiment in call option. Investors have bullish sentiment, and after some point of time, when the price increases, you'll sell it, okay, and get rid of it and make your profits. In the same way, the mortgage prepayment is you will make the payment earlier and get the benefit. Okay, how you will get the benefit? Because if you make the prepayments earlier, the earlier payments or premature payments, you will save yourself from the extra additional interest payments and get rid of that liability. Mortgage prepayments take one of two forms: increasing the amount frequency of payments, or refinancing the entire outstanding balance. So mortgage prepayments take one of two forms. Either you make prepayments much often, or else you approach some another bank to make the complete outstanding payment there and then and settle your loan. If you have if you get less, if that bank offers you less interest. Okay, suppose I've taken a loan from SBI, and the SBI guys are charging 7.30 as interest to me, and ICICI Bank comes and tell I will refinance, and you just take the loan from us. We will give it to you for 6.90. Okay, we'll give it to you for 6.90, and there I am saving good amount of interest, correct? Because it is 0.40 less. So what do you say? I will get it refinance. Am I right? By the other bank. So this bank won't like those things also, because this bank loses the interest. That bank will get the interest now. So the four reasons of prepayment are refinancing, turnover, defaults, and curtailment. So prepayment, why people do? Because they get good refinance from other bank, or they have good turnover. Am I right? Like good sales in their business. Good, they are generating good cash inflows, and they don't want any kind of default in the future. That means they think that future is risky or something, or they want to curtail their loan tenor, or they want to get rid of this loan. Okay, I explained you what is refinancing, so I need not explain. Chandra, shall I move forward?
Yeah, sir.
Hello.
Yeah.
Yeah, and
Yeah,
this
sir.
also I've explained. I have this nothing to explain in all this, because I've explained you in a generalized way. So that is what you can do. Turnover is nothing but, suppose this house in which you are, na, if that is giving you, suppose the turnover prepayments are made following the sale of house. Housing turnover increases at certain periods during the year. Example, over summer when weather is favorable. That means, suppose you have taken a house on loan and you have taken it for 3,000 rupees per SFT. Now it has gone for 5,000 rupees per SFT. You're getting good amount. So you can sell it, na, by taking NOC from bank, and then you will try to, at that point of time, you need to close your loan. So that time you need to repay your entire amount and close it. So bank won't like that also. For bank it's a risk. Okay. So defaults occur to agency mortgage backed security. The agency will pay the outstanding loan amount of any defaulter of an agency mortgage backed security. This payment is treated as prepayment. This defaults occur to agency mortgage backed securities. Acha, 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 acha. Okay, the agency will pay the outstanding loan amount of any defaulter of any agency. I mean to say, if suppose there's a default, so if you have taken some insurance or something, that time also prepayments will be made. Okay, fine. Defaults occur to agency mortgage backed security. The agency will pay, okay, the someone who has issued this. So at that point of time, they'll pay the outstanding loan amount, and these guys can make a prepayment. Fine, understood. Okay. Monte Carlo simulation in the valuation of mortgage backed security. So what do you mean by simulation, Chandra? Can you tell me an example? We are about to finish this chapter. What do you mean by simulation, Chandra? Hello.
Hello?
Yeah, what do you mean by simulation?
Sir?
Simulation.
I think it's a statistic.
No, no. See, simulation is a method with which you try to get lot of outcomes for your experiment, kind of. How? See, suppose you know there are pilots. Am I right?
Okay, sir.
So these pilots, before flying a plane, fighter plane or a normal plane, first they will be, they have to get, like they have to practice a lot. That means they will be put into a simulator, and you know, like, have you seen National Geographic channel? They will rotate, they will put, ask the pilots to sit, and they will rotate it very fast, like, because fighter planes will be doing lot of maneuvers. Am I right? Acha, small example, have you have gone to many malls now?
Yeah, sir.
So there will be bikes.
Yeah, to show. Yeah.
That, no, that toy, that means
Yeah, yeah,
children
yeah.
will play video games.
Yeah, sir.
So that video game, he will sit on that, and he will try to run that bike, and he will see himself in screen, and that will show, that will give him real life experience. That means bike will also shake, bike will be like, give like, it will have some brakes kind of thing, like that. Whatever you apply, you can see there, so it will give you real life experience. That is called simulation. So before, so simulator is nothing but something, uh, of whatever the real thing you are going to see, a dummy of that, that is simulator. And you conduct lot of experiments on that, and then you enter, you just go for the real thing. Okay, so that is simulation. So Monte Carlo simulation in the valuation of mortgage backed security. So a popular method for valuing MBS is called the Monte Carlo methodology. So we have also done this Monte Carlo in VAR concept. Okay. So the simulation creates thousands of interest paths. So as I said right now, the same thing. Here, what you are doing, you are creating thousands of interest paths. That means you yourself are experimenting. Okay. So you want to see how will you behave on each and every path, like that. That means, suppose I want to go to some place, I will make 10 paths on a book or a diary. That is also a simulation concept. So now that the MBS could follow over its life. So mortgage backed security, the interest is not something which is fixed. It is volatile. So there will be sometimes the interest will be high or interest will be low. Okay. So see, you know, one good concept. There is a inverse relationship between bond price and the yield to maturity. You know that, na?
Hello?
Hello.
Yeah, sir.
Yeah, there is a inverse relationship between bond price and yield to maturity. You know that
Yes, sir.
concept, na? We already discussed.
Yeah.
What is that concept? Can you explain me, Chandra?
We- hello?
See,
Yield to maturity, right, sir?
yes, yes.
Yeah.
What is that concept?
We'll get the
Suppose
yield.
you have,
It's
suppose,
it's basically on bonds, right, sir? Yeah.
yeah,
We'll
suppose you have,
we should, yeah, we will get the yield on the basis of bonds with a maturity period.
no. Suppose you have taken a security, okay,
Okay.
and the price of that security is 1,000 rupees, and the company has promised to give you a coupon of 10%, that is interest. And in the market,
Huh?
after hello,
Yeah, sir.
yeah, in the market, after 2 to 3 years in the market,
Okay.
after 2 to 3 years, similar kind of security is giving 12%. So now you don't like to hold your company's bonds. You want to sell it. So you will sell it at a higher price or a lower price.
Sir?
See, suppose you have purchased a security for 1,000 rupees, okay,
Okay, sir.
and the company of which you have purchased the security is giving you a coupon of 10%. That is the interest.
Okay, sir.
And after 2 years in the market, the interests have gone to 15%. That means
Okay.
people who
Yeah.
have purchased similar
A
kind of
10,
bonds,
a 10, a 10 rate of interest. Yeah, sir.
the people are getting more returns on that. That means good
Oh,
15%. So now
okay.
you will sell your security at higher price or lower price because you don't want to maintain or hold that security. It is giving less interest to you. You want to purchase some other
Yeah.
security.
Some other security, we will sell it, sir.
You will sell it lower price or higher price.
Lower price.
Why?
Why? Because no, it is giving less, so the other people also
Yeah.
think. Yeah.
So your the demand for your security will be less. Hence, that's what we can see here. The relationship when yield to maturity increase, that is, it has gone to 15%. Your bond price will decrease. Okay, because it has less demand in the market, and vice versa. If interest rates go down to 7%, you will sell at higher price because your company is paying more. Okay, so that's what. So you will be putting all those things like thousands of interest paths that your mortgage backed security would follow over its life. So the process recognizes the fact that there is a probability distribution of the possible outcomes of an MBS. Yeah, if you are holding a mortgage backed security, suppose you have a bond of some company which is a mortgage backed security, that means that company has converted a lot of mortgages into, that means bank, we can take company in the sense bank has converted lot of securities, lot of mortgages into mortgage backed security, and it has issued to people. Now like the now the people will get any possible outcome you can get now, like you can get higher interest, lower interest, anything. Now taking into account multiple interest rate paths is important because interest rates impact repayments. Okay, that means if the interest rate, if you are getting good interest now, Chandra, from your security, you will hold it. If you are getting less interest, you will sell it. Am I right? That means ultimately you are repaying to the, what is that actually? See, you take yourself from the bank's perspective. If the interest rates are rising, suppose you have promised to give 10% coupon. Suppose it's a security which you have issued that is at a floating rate. Okay. And the interest rates are high. So will you make high interest payments, or you want to make you want to get rid of that? Hello.
Hello,
Hello.
sir.
Hello.
Yeah,
Yeah,
sir.
Chandra, my
Is it audible?
you have issued securities to people, and those are
Okay,
mortgage
sir.
backed securities, and now the interest rates are have increased in the market. So
Okay, sir.
you now are bound to pay higher interests. So will you pay that? No,
Okay.
no. Instead of that, what you want to do? You want to repay the money soon.
Yeah.
So therefore impact the amount and timing of cash flows to the investor. So investor will not be happy. Why? Because investor doesn't want prepayments. That means he wants to hold it for longer period of time and enjoy interest. So that is what they're saying. Now there are 4 steps required to value a mortgage security using Monte Carlo methodology. First, to simulate. So first you create paths. That means refinancing paths. When you want to refinance, like that means when you want to pay them money, na, who? The investors. So you also want to get some finance from someone. So are you getting that refinance or not? Okay, and then project the cash flow on each interest path. That means how much cash you have to make the payments. Then present value of cash flows on each interest rate path, and then compute the theoretical value of mortgage security. Nothing but first you should see like when will you get the refinance to make the payments to the bondholders, and then you have to see like what is the cash you will be making in the future, the payments. What will be the cash payment you will be making in the future? Then today what is the value of that? You need to find out the present value of that. What you're going to see, it is like a bond, Chandra. Bond is nothing but What is the see? Hello, hello, hello.
Hello? Yeah, sir.
How will you find out the bond price? Bond price is nothing but, see, suppose you are going to purchase a zero coupon bond. So you are paying 800 rupees for that zero coupon bond. Okay. Or suppose you are going to purchase a bond from a company. So what is the price you need to pay to purchase that bond? So the price you need to purchase that bond is nothing but present value of future cash flows of that bond. Am I right? Hello?
Sir,
Yeah, what is the price which you need to pay to purchase the bond? The price you need to purchase the bond is the present value of future cash flows.
yeah, sir.
That means how will you get the present value of future cash flows? In the company to which you are going to make some payment to purchase the bond is going to give you the money in the future with interest. Am I right? So company will give you interest every year, and at maturity it's going to give you 1,000. Suppose I'll just come with an example. Just a second. Okay, leave it. I'll show here. So how will you find out the calculation of bond price? How will you do? We will be studying this in that valuation book. See here. They are using this calculator formulas. Okay, no problem. See here.
Hello?
Yeah, yeah, I'm showing you. Just a second,
Yeah,
Chandra.
yeah. Okay, sir. Okay.
Yeah, yeah, yeah. So this is the way you will be finding out your bond price. Okay. Bond price. How will you find out? Suppose there is a bond. We'll see a practical example. So this is what you will be doing. See, firstly, the face value or par value of bond issuance is determined as per the funding required of the company. That means how much they are taking from you. Then they will give you coupons. First coupon, second coupon, third coupon, fourth coupon. Okay. And then face value of the bond. So face value of the bond is nothing but the value of the bond. That will be $1,000. Got it? So this coupon payments for how many years plus the face value of the bond, this you will be discounting and you'll be getting the bond value. Say for example, let us take an example of a bond with annual coupon payments. Okay, a company has issued a bond having a face value of this, carrying the coupon rate this and maturing at this, and the yield to maturity is this. So you'll be taking yield to maturity to find out your bond price. Okay, how will you do that? You will put all this in the formula. The face value is 1 lakh divided by 1 plus r whole power. How many years? 15. And then this is the annuity formula, the present value of annuity formula, which we saw yesterday. So this will be giving you the bond price. So how much is the bond price? See, 83,878.62. And how much you are getting at the end? 1 lakh. Okay. Got it? See here. Okay.
Sir.
Yeah, tell me.
Yeah, sir.
Got it now, this one?
Yeah, sir.
Are you sure, Chandra?
I'm sure, sir. I'll revise it once if I have any doubt also. It's not a problem.
Oh, okay, okay. See here again.
Okay.
Cash flows 4,000, 8% coupon rate. So it's for 10 periods. You got this, and this is the discount. This is the annuity. You can directly use the annuity formula for this. This is the value. So totally bond price. Okay, this is a different question, I think. Yeah. Yeah, that is example two. So here we are. Okay. So this is again one more question. And that is also the present value you have got is 1,04,158. How you got that? This is you have discounted, and again last year principal plus interest. The present value is this. So when you calculate, you are getting this one. That is what they are saying here. Now, option adjusted spread OAS. What is this OAS? When modeling the value of mortgage backed security, the option adjusted spread is the spread that when added to all the spot rates of all interest rate paths. So you will be making a lot of interest rate paths. Interest rate paths are nothing but as per the Monte Carlo simulation model, whereby you will be creating some paths and seeing how the interest rates will be behaving. Okay. So when modeling the value of mortgage backed security, the option adjusted spread is the spread that when added to all the spot rates of all the interest rate paths will make the average present value of the paths equal to the actual observed market price plus accrued interest. That means whatever the present value you will be finding out for all the interest rate paths, whatever you have created, will be equivalent to the market price, okay, plus the accrued interest. So market price plus accrued interest is nothing but market price of that bond plus the outstanding interest which you are supposed to get, that will be equal to the present value of the interest rate paths. Okay, that is OAS. Now next one, this is the formula. So where n is the number of interest rate paths. Okay. So while the left hand side of the equation above gives the current market price of mortgage backed security, the right hand side gives the equation of Monte Carlo model's output of average theoretical value of mortgage backed security. That is, present value of the interest rate paths. As I've explained to you, this is very much similar to the bond price valuation. So fine, this is okay. Okay. We can view that the OAS, that is the option adjusted spread. Yeah, just a second. As a measure of MBS returns that take into account two types of volatility, changing interest rates and prepayment risk. So these are the two volatilities for the bank. One is the interest rate changes, and that means the interest rate should not go high if it's a floating bond, and the prepayment risk. That means these guys again need to make the prepayment and they have to arrange for the funds. So the OS should not be confused with Z spread. The Z spread is the yield that equates the present value of cash flows from MBS to the price of MBS discounted at the treasury spot rate plus the spread. So what does it mean? Z spread and OAS are different. The Z spread is the yield that is equal to the present value of cash flows from the mortgage backed security to the price of the mortgage backed security discounted at treasury spot rate. Treasury spot rate is nothing but the government rate plus the spread. However, it does not include the value of embedded options, that is prepayment. That means prepayment option will also be there. That is not considered in Z spread. So which can have a big impact on present value because prepayment can also happen. We cannot ignore the prepayment. Okay. Now, option cost is zero volatility spread minus the option adjusted spread, and option adjusted spread is the byproduct of Monte Carlo. Yeah, from that only it's inspired. Okay, and but it has several limitations. It is dependent on some type of prepayment model, that is PSA model. PSA is one of the prepayment model. We have seen the CPR also. Okay, as established earlier, most of these models are based on historical data, but like which is very essential for you to get reconcile with the actual future results, and it makes your task more tedious. It is subject to all modeling risks associated with simulation. Yeah, see, it is not like if you are following a method, there's no risk to that. There can be some modeling risk. Modeling risk is nothing but whether the model which you are using for finding out your answer to the question what you want, that is a suitable model or not. That's a modeling risk. So the process of adjusting interest rate paths is subjected to modeling error. There can be modeling errors also. And OAS assumes that investor hold the security to maturity, while in reality, it's not necessary. They can, they will hold till maturity. They can sell it to someone else. Okay. Done with this chapter, Chandra. Give me a 5 minutes break. I'm coming out with the next chapter. Okay. Hello, Chandra. Are you online? Hello. Hello.